Okay, so it looks like the recording has started, so we're officially starting now. Welcome to everybody. We're doing our second webinar, a fully online version of the Cornell City Financial Data Science webinar. And so this is the second time we're fully online. And you know, as we all know at this point, there's some pros and some cons to be fully online. The cons are we don't have any snacks to offer and no dinners for Rama and Francesco, although we definitely owe him one. We owe both of them one. So we're excited about this version of the seminar because it allows us to go international and have access to some really great researchers who otherwise may not be you may not be exposed to. So I'm really excited to have Rama Cont and Francesco Capponi. So I've known Rama for quite a while now, more than a decade. We were colleagues at Columbia, and at the time we came across some interesting data sets on limit order books that sort of intrigued us, and we took a hack at it. We wrote a few papers. We did some order book simulations. We looked at statistics and the relation between market depth, price impact, order flow, and we sort of started on these topics that we're both still passionate about, but now we've each gone on our sides of the world. Rama is now in Oxford, and his student Francesco Capponi is now in London. So he works at BlackRock, and essentially I'm very excited to have both of them present today. So without further ado, their topic is cross-impact in equity markets.
Yeah, thank you very much, Sasha. Thank you for inviting us to present in this seminar. So I would have loved to be there in person, but maybe next time. So yes, as Sasha explained, this work goes back to something we did together with Sasha and with Arseny Kukanov, who is somewhere in the audience. Hi, Arseny. And so the topic of this work is the concept known as cross-impact, and we investigate this concept by doing a detailed analysis of order flow and price data from equity markets. So let me go into the topic without delay. So I guess most of you are familiar with the concept of market impact. So market impact is the idea that the execution of trades may move the price of an asset in the market and thus contribute to the cost of execution. If you send a large buy order, you probably notice that this may move the price up, and so you end up paying more than if you had not moved the price. So this phenomenon known as market impact has focused a lot of attention because it contributes to execution cost. And if you look up any reference on transaction cost analysis, there is a lot of effort devoted to quantifying and managing market impact. And there's a huge literature on optimal trade execution, whose focus is the optimization of trade-off between volatility and impact. So empirical studies on market impact show that, not surprisingly, I mean, this is in line with Economics 101, price movements are driven by aggregate imbalance between supply and demand. If there are more buyers than sellers, the price is driven up. If there are more sellers than buyers, the price is driven down. So you can formalize this by defining the notion of order flow imbalance. So you look at the buy volume minus the sell volume, or if you are in a centralized order book situation on an exchange, you can look at the net order flow at the top of the order book. And this concept of order flow imbalance is very useful for building impact models because you can show empirically that the returns of an asset in in a centralized order book market are well described by a linear impact of the order flow imbalance. This is something we explored in detail with Sasha and Arseniy Kukhanov. Oh, sorry, I put 2020. That's actually 2014. But there are lots of other studies. We looked at it in equity markets. There are other studies in other asset classes. So this is basically confirming that what we know from Economics 101, that aggregate imbalance between supply and demand is what drives the price. Okay. Now, so from a quantitative perspective, it means that, well, there is this approximately linear relation, to a very good approximation, between the return and order flow imbalance. And so you can think of it as a regression model. And if you do this regression, well, the coefficient in the regression, which I call here the beta, is what people call impact coefficient. So a high impact coefficient means a small imbalance can create a large move in the price. A low impact coefficient means the opposite. So it's the opposite notion of liquidity. And you know, one of the interesting things we showed in our study is that if you do this regression, then again, to a very good accuracy, the coefficient you find here is the inverse of the order book depth. So properly
Can I
defined.
interrupt you 1 second?
Yes.
Are you on the second slide or third slide? Because we only see the first slide.
Oh, you're on the title slide still?
Yes, we are on the title slide.
Oh, that's not good.
So it might be
oh, sorry.
something to share.
So I don't know what's going on here. Stop share. Let me share again. Okay. Do you see it now?
Oh yeah, now we see that so you're on the second slide? Yeah.
Yeah.
Yep.
Okay, sorry. So anyway, I was just saying what imbalance is and what market impact is. So you can translate these ideas into a linear model of market impact, which is what we did with Sasha and Arseniy. So this, you can think of it as a regression model. You try to explain the returns in terms of the imbalances of each stock. And you can interpret the regression coefficient here, beta, as a measure of market impact. So high beta means a less liquid asset for which the same imbalance leads to a higher price movement. And if you look at it quantitatively, which we did, you find that this coefficient is highly correlated with the order book depth, or depth at the top of the book. So you can interpret this coefficient as inverse of the order book depth. Okay, so these are well known, and there are a lot of other studies confirming the same things in other markets. And if you look at this equation, well, it's a linear equation, so you can also extract the impact coefficient, which we call here the beta, as in terms of the covariance of the return with the order flow imbalance. That's another way to do the same thing. When you do a regression, it's just a covariance calculation, basically. So it means that if you have impact, you will see positive of a correlation between the return and the direction and the size of the order flow imbalance. And that's what we see in all the examples of markets where this kind of empirical study has been done. Okay. Now, so this study I mentioned was for single stocks. So we looked at all single stocks in the NASDAQ when we did this regression, but most market participants are interested in portfolio transitions, portfolio trades, or they simultaneously execute trades across many securities. And so they have access to order flow imbalance and returns across multiple assets. And they have looked at whether there's correlations across these variables across different assets. And it turns out that yes, there is a positive correlation of order flow on one security with the returns of another security. So if we take, for example, the order flow imbalance on Apple and you look at the correlation with the returns of Microsoft, well, typically you do find a positive correlation. So that's, so examples are shown here. These are examples from NASDAQ order book data. So you look at, for example, the return of Apple over 1 minute intervals. You look at the correlation with the order flow imbalance of Intel. Well, you get a correlation of 40%. It's opposite. You look at the return of Intel correlated with Apple, 35%, 34.6%. So you can see, first of all, it's positive. They're not small and it's not symmetric. Correlation of return of Google with order flow imbalance of Amazon, 31%. The opposite, the other way around, it's 19%. So what we see, if you do these calculations for randomly chosen pairs, you'll typically see positive correlations of the return of one asset with the order flow imbalance of another asset, and they're not symmetric in general. Okay, so this is interesting. Can you extract information from this? Well, this observation that price movements in one asset may have non-zero correlation, and they actually do have non-zero correlation with order flow in other assets, has given rise to a concept that people call cross-impact. Okay, so cross-impact simply refers to the observation that when the trades in one asset correlate with price moves in another asset. Okay, now from this observation has grown an idea, which is slightly different, is that, well, oh yeah, we see these correlations, they must have some origin, and the origin is probably the fact that the price of a given asset is not influenced just by its own order flow, but also by the order flow of other assets. And so if we are in the context where we trade more than one security at a given time, this may influence the price of other assets that we hold. Okay, so this is the notion really that people refer to as cross-impact, and there have been a lot of theoretical and empirical studies on this. So empirical studies, I'm not going to review all of them, but you see a list there. Empirical studies have documented this correlation effect that I just mentioned. Here I showed you 4 examples, but people have looked at this in equity markets, in bond markets, and so on. And they generally see the same effect. There's a positive correlation between the order flow of one asset and price moves in another asset, at least in a homogeneous asset class. And then there are theoretical studies where people have tried to derive the consequences of such things. We say, well, if actually the order flow of one asset influences the price of another asset, then we should account for that in optimal trade execution, portfolio execution, so on. So there have been a stream of studies trying to extend what has been done for single asset optimal trade execution to multiple assets where the model includes such cross-impact effects. Okay, so what is the idea in these models? Well, the idea in these models is that we observe this non-zero covariance terms, of which I showed you examples. So the price movements in asset I are correlated with the order flow asset J. So to model this, they introduce a market impact model in which order flow in any asset can influence the price of another asset through some coefficient, which called the cross-impact coefficient. So as you can imagine, if you have like 500 stocks, well, this leads to, 500 squared divided by 2. So a fairly large number of cross-impact coefficients. So tens of thousands of cross-impact coefficients that you need to estimate. So from one coefficient in a single stock impact model, you move to n coefficients per stock, when n is the number of all other stocks that you trade, plus eventually ETFs and so on. So this leads to non-parsimonious models, and you know, you have to estimate them and see if the coefficient is stable or not. So that's a non-trivial problem. And so that's in the empirical studies. And in the theoretical studies, well, the authors assume that this they need this full matrix, but without necessarily analyzing why the effects might arise, what leads to this effect. So these studies assume there is such a thing as a cross impact, and then they try to optimize the execution strategies taking into account such coefficients. Okay, now, so the questions we're going to ask here is that, first of all, you know, the notion of cross impact, the first time I heard of it, it really sounded fishy to me. So for those of you who have studied the physics, you know, this sounds like action at a distance. You know, in the old days, when Newton introduced his theory of gravitation, well, it was really not accepted in the beginning because people said, well, what are you trying to tell us? I mean, you're trying to tell us that if you have a planet here and another planet there, they're very far from each other. Somehow the first planet exerts an action at a distance on the other planet without any physical contact. Is that serious? So, so that's this notion of action at a distance was criticized because you know, people have this idea that there needs to be a mechanism which brings things into contact in some way. There needs to be underlying mechanism which links A to B in order for A to affect B. So to have a causal impact, you need to have some link between the two objects. So here, well, it's not hard to understand the single asset impact model that I showed you in the beginning, because that's really the supply and demand for a good drives the price of that good. More buyers will increase the price, more sellers will decrease the price. That's really economics 101. But why would the excess demand for one asset impact the price of another asset? Well, you also see this in economics. You have what's called substitution effects. For example, if people decide to consume less bread because they switch to, you know, something that is different, like they switch to rice, then of course the price of rice will go up and the price of bread will go down because they substitute one for another. So it might be something like that. But we're going to look at data which is at the intraday level, like seconds. So it is not, you know, that's not the kind of thing that we're going to look at where you have substitution of assets on a large scale. So pension funds shift from one asset to another. So the first question we're going to ask is this real? So what does it mean, is this real? Well, for quants, the real means, do we need it to explain some observable facts? Because we're not going to ask a philosophical question. So the question we're going to ask quantitatively is that we have these effects, we have observed that there is a covariance of returns of some assets with the order flow of other assets. They have some magnitude. Do we need to introduce all these cross-impact coefficients, and there are many of them, to explain the correlations that we see? And if yes, do we really need, in particular, an n-by-n matrix of price impact coefficients with non-zero off-diagonal elements, which makes it a huge amount of coefficient to handle, to model market impact and observations of relations between order flow and prices in a market with n assets? Or is there a more parsimonious approach for this? Okay, so these are some of the questions we're going to ask, and it's really, these are questions that you would like to ask when you design a multi-asset impact model, because if you don't need those n squared coefficients, you really don't want to have them. Okay, so here is a summary of what I'm going to try to show you, so in summary, we're going to try to convince you that this notion of cross impact is really not necessary to explain anything, and the observed covariations, of which I gave a few examples, between price moves in one asset and order flow imbalance in other assets can simply be explained by a simpler and more intuitive observation, that is that order flow imbalance across assets are correlated. And why are they correlated? Well, guess what? Because very few market participants just trade in one asset. They typically trade, they have portfolio strategies which involve multiple assets. These can be index strategies, ETF strategies, statistical arbitrage strategies, such as pair trading, other cross-asset strategies, which involve multiple assets. So they typically generate correlated order flows across assets, and these correlations lead to correlations in the order flow imbalances, and that's what we will show that this quantitatively explains very accurately all the cross correlation effects we see between order flow imbalance in some assets and the returns in other assets. So that's a summary, and now I'm going to go into more detail in the model. So here is in one diagram what we call a causal model for execution costs in a multi-asset framework. So, so the basic idea is that you need nothing more than the single asset impact model that I showed you on slide 2. So what drives the price of a stock or any other asset, in fact, is the order flow imbalance, is the buy minus sell imbalance in that asset. That's it. That's it. There's nothing else. So now, what are the components of the order flow imbalance in this asset? Well, you can think of two types of components. There are entities, algos, or humans. There's still some humans who trade stocks, who will trade only stock I. There are other algos which will trade only stock J. And these will contribute to what we would call the idiosyncratic order flow for stock I or stock J. These have nothing to do with what's going on in other stocks. They look at some technical indicators for that stock or some value strategy for that stock, and they don't really look at the other stocks. But there are other market participants engaged in multi-asset trading strategies involving multiple assets, indices, other stocks, and so on. So these strategies also generate orders for stock I and stock J and all the others. And so they feed into the order flow imbalance. And what we see, what drives the price of the stock is just the aggregate order flow imbalance, is the algebraic sum of all these buy and sell orders. And because there's this common component of order flow, which is triggered by entities simultaneously trading in I and J, well, this leads to correlations across the order flow, and in particular, the order flow imbalance of stocks I and J. Therefore, you will see correlations in the returns of stock I and stock J if the relation between, and if the relation between the return and the order flow imbalance is linear, as we assumed in the beginning, then the correlations between the returns should closely reflect the correlations between the order flow imbalances. And you should need nothing more to explain all these things. On the other hand, the cross-impact model is different, because the cross-impact model involves drawing inserting in this diagram an arrow which would potentially go from this pink box here, the order flow of stock J, directly to the return of stock I, or from the imbalance of stock J directly to the return of stock I. And so you would have in the cross impact model, you will have you have oblique arrows in this diagram, whereas in the diagram that I'm showing you right now, they're only vertical arrows. Only the order flow of each stock influences the return of that stock. So this is a very traditional view of things. There's nothing really revolutionary. Supply and demand drive price for each asset. And there are people who trade the assets simultaneously, so they create correlation in the order flow imbalance, whereas the cross-impact model requires you to accept this action at a distance thing where I trade stock I and suddenly this moves stock J through some mechanism that is unspecified. So the thing is that we can test which one of these two assumptions is true because we have data on order flow, we have data on the return, so we can actually check which one of these assumptions is more plausible by conditioning on the variables in this diagram and performing conditional regressions. And that's what Francesco will show you in a few minutes. But before that, let me comment on the very construction of these impact models for multiple assets and the inherent identification problem that arises from them. So how are these impact models specified for multiple assets? So it's really a multidimensional version of the equation I showed you in the beginning. So you had that for one stock, the return is a linear function of an affine function of the order flow imbalance. And you say, well, okay, I have n stocks now. Everything is a vector. I pile up the returns in a vector size n. And order flow imbalance also, I have n of them. And now I allow any variable in the order flow imbalance vector to influence any other variable in the returns. That means I will have a matrix of coefficients where beta II on the diagonal is the impact of stock's order flow on its own return, and the off-diagonal terms beta ij will be the impact of the order flow of j on the return of I. And there is nothing to suggest that this matrix has to be symmetric. In fact, we saw that there seem to be asymmetric effects. So why not allow it to be completely arbitrary? Fine.
Rama,
so that's the full. Yes.
Sorry to interrupt you, but there's a question. I was going to leave them all for the end, but there's one that's
Yes.
relevant. Is Jinping Shi is asking, how is OFI calculated?
Yes, I will come back to this in a few minutes. But so OFI is the net order flow for stock I, which can be defined in many ways. So the way we're going to define it here, we're going to look at the order book. We're going to look at the best bid and the best ask you. Okay. So and we're going to, it's a flow variable. So we're going to look at every time interval. So say 1 second or 1 minute. We're going to look at a time interval and we're going to look at all the buy orders that come in, new buy orders, minus all the cancellations of buy orders, and minus the execution. So that's the inflow to the bid queue. And then the same thing for the ask queue. We're going to look at all the sell orders that come in, minus all the sell orders that get canceled or executed. And then I'm going to do bid inflow, so buy, increase in buy orders minus increase in sell orders. So that's going to define the order flow imbalance. You can think of it as net buy minus sell volume. Okay, but we're going to define it more precisely in a few slides. Sorry. So okay, so here is the model for n stocks, and now. Well, we have a linear model with two variables here. On one side, the returns, and on the other side, the OFI, the order flow imbalance. So we can look at a few, look at the covariance matrices of these things. So we have the covariance matrix of the returns, we call it C. We have the covariance matrix of the order flow imbalances, we call it K. And then the quantities which I showed you in the beginning, these are the covariances of the returns with the order flow imbalances. And you can calculate this in the linear model, because if the return is beta times order flow imbalance, then the covariance of the returns with the order flow imbalance is just the beta matrix times the covariance matrix of the order flow imbalance variable. Okay, and this matrix is what you observe when you do the covariance calculation between the order flow of one guy and the return of the other guy. You observe the elements of this matrix M, which is just beta times K. Now, when you read a lot of discussions on cross impact, they observe the matrix M, and they use the fact that M has off-diagonal elements to imply that somehow you need to have off-diagonal elements in beta. Well, that is not exactly correct, because you can see that here we have a matrix a product, and if you know what a matrix product is, and we all know, then you can see that there's no need to have off-diagonal elements in beta in order to get off-diagonal elements in M. Now I'm going to show you an example where you can see why this is the case. So let's look at a case with two assets. So we have two assets, each one has an order flow imbalance, and this is and I allow for cross impact. So here the cross impact models are beta 1, 2 and beta 2, 1. So each order flow imbalance is allowed to influence the other variable, the return of the other stock. Now in this model, you can calculate everything easily. So I assume the residuals here are independent. So any cross correlation can only come from either the fact that the order flows are correlated, or from the fact that you have off-diagonal elements in the beta matrix. So if you allow for the general case where order flows can be correlated and you can have off-diagonal elements in the impact matrix, then you get that the covariance of the returns with the order flows has this horrible expression. It's horrible, but it's very simple. And so you can see that if you look at the off-diagonal elements here in M, well, this is the covariance. For example, this, you see when the hand is on the, okay. Can you see the cursor? Okay, so here, as you can see, this is the covariance of the order flow of stock 1 with the return of stock 2. And you can see that it's a combination of two terms. One of them involves the cross impact matrix beta 1, 2, but the other one involves the correlation of order flows between 1 and 2. So this term can be non-zero and positive for two different reasons. One reason is that there is correlation, there's a positive correlation in the order flows of the two stocks, but there is no cross impact, or that there is no correlation in the order flows of the two stocks. First term is 0, but there is cross impact, or it can be both. So you can see that just by looking at these correlations of the return of I with the order flow of J, I cannot identify which is which, because I have one observable and then I have two different parameters here at least, and this is only for two stocks. So these cross impact coefficients cannot be identified just from the covariances of the returns with the order flows. I need to know something about the correlation of order flows, or I need to assume something about the correlation of order flows. So it's very clear from this example. Let me show you an example with numbers in case you don't like the letters. Well, here's an example where I have two stocks. This is and I look at two cases. This is in the first case, I have no correlation in the order flows, okay? But there is cross impact. So every time I trade a 1, I affect the price at 2, and there's some cross impact coefficient that is 0.3, smaller than the own impact coefficient. So if you combine these two in the model, it leads you to a covariance matrix for the between the returns and order flows, that is this one. So it shows in particular that the return of stock 1 is correlated with the order flow of stock 2 at 30%, quite high. And the case 2, same stocks, but now we assume that the correlation in the order flows is 50%, but there is no cross-impact coefficient, 0. Well, it leads to exactly the same covariance matrix for the covariances of order flow with the returns. So exactly the same. So if I only observe the covariance of, if I only do a regression of the order flow on the returns across all stocks, I observe this matrix M. This does not distinguish these two situations, but they're very different. One of them says, you know, you have to model the correlation in order flow across stocks. That's the real thing. The other one says, you know, you have to understand this cross-impact thing and model that. Okay, so this example clearly shows that simply observing a non-zero correlation between order flow of one asset and the return of another asset does not imply that you need a non-zero cross-impact coefficient in the model. And this is for 2, and if it's 500, then it means that it does not imply that you need those 25,000 coefficients. So, very easy to understand in this example. So in this example, I choose either the correlation in order flow to be 0 or the cross-impact to be 0, extreme case, but it doesn't have to be this extreme. You can have both of them non-zero. So here's another example. Low correlation in order flow, high cross-impact, or low cross-impact, high correlation in order flow lead to exactly the same outcome in terms of covariances of order flow with the return. So again, you have this problem, same correlation between order flow and the returns for any pair of stocks you want, but the amplitudes of the cross impacts are different in the two cases. So again, you cannot infer the cross impact, either the fact that it's non-zero or it's small or big, just from these covariances. So you do need to be less but lazy and look at the information in the order flow themselves, and that's what we're going to do. So now I turn to Francesco, who is going to tell you the real stuff. So what actually the data tells us.
Okay, thank you, Rama, and thank you, Sasha, for inviting me. Now we look at some data. We look at limit order book from NASDAQ 100 stocks. We have data for about 2.5 years. Rama, you need to share.
Oh, okay.
Your
yeah, it disappeared.
Okay. So we have data for 2.5 years, and we filter out some stocks that were not covered during the period. So we end up with a total of 67 stocks. So if you can move to the next slide, please. So some definitions. So the returns is a standard mid-price change. Then we have the order flow imbalance, which Rama discussed before. It's just the net order flow. So at the bid, which is the limit buys minus the cancellation minus the market order, market sell orders, and the net order flow at the ask, which is kind of the symmetric. So the limit at the ask minus the cancellation minus the market order by market orders. So the order flow imbalance is the volume at the bid minus the volume at the ask as defined below, and it's a measure of net demand, basically. So in order to make things a bit more interpretable, we follow Obizhaeva, and we redefined, we scale we normalize the returns by the volatility of the stock, by the 1-minute volatility. We compute the daily volatility using realized volatility from Anderson, and we scale it to have 1-minute volatility. And the OFI, we scale it by the average volume, which is the average volume of during the 1-minute bucket, corresponding to the same return. If you can move to the next slide, please. So this is a very clear graph that shows the distribution of the correlation coefficients of the OFIs of two stocks, OFI of stock I and stock J, which is in blue, and the correlation of the return of I with the OFI of another stock J, which is what Rama discussed before, which is the red one. So we can clearly see from here that the distributions are almost indistinguishable. They are very, very close to each other. And yeah, I mean, the mean is about 0.25. If you can move to the next slide, then this one actually shows in a better way, because for the same pair of stock I and J, we plot the correlation of the order flow imbalances on the x-axis and the correlation of the return with the OFI of a different stock on the y-axis. And we can see that for the vast majority of stock pairs, the points are very, very close to the 45-degree line, which indicates equality. And this is a strong suggestion that the correlation between the returns and OFI, which once again is the definition of cross impact, could simply be due to the correlation between order flow imbalances, which is our main hypothesis.
Sorry, if there's a question in the chat which says, what's a typical time interval used? Just for clarity, these are all 1 minute data. 1 minute OFI, 1 minute returns.
Yes, correct. Can you move to the next slide? So to test a bit more formally whether or not we need a multivariate market impact model, we use two approaches. I mean, initially we just ran a regression where the return of a stock is regressed against all the order flow imbalance of its own and all the other stocks, all the remaining 66 stocks. And this heat map below just show the coefficient, the beta coefficients. So that's the beta matrix that Rama was explaining. And he asked the question, do we actually need all these off-diagonal elements in this huge matrix? Here, the off-diagonal elements are those in yellow, which are very clearly close to 0 and much, much smaller than the diagonal elements, which show the impact of a stock's own order flow imbalance on its own return. If you move to the next slide, then to be a bit more clear in terms of units, I guess this one shows a bit better what the distribution is. So the relative frequency distribution of the market impact coefficients from these regressions. The blue is the self-impact coefficient, so-called. So it's the impact of a stock's own order flow imbalance on its own return. And the red is the cross-impact coefficient, which is the coefficient of another stock's, all other stocks, basically, OFI on a stock's return. So we can see that the mean of the self-impact coefficients, I mean, the scale is completely different. The self-impact coefficient has a mean of 2.64, whilst all the cross-impact coefficients are, again, as I said before, very, very close to 0. They are 0.032 mean. And particularly, there are also some coefficients which are negative, which kind of contradicts most of the assumption on cross-impact, which assume a positive correlation between order flow and returns. So this means that even if there are even if they were identifiable, then they're actually very, very tiny, only about 1% of total impact. If you can move to the next slide. So, I mean, this is just the first approach, so a direct regression. But as we explained before, and as Rama explained in the causal graph, this approach doesn't take into consideration the fact that stocks are traded in portfolios, in baskets, for many different reasons, and that not taking the commonality of order flows into account clearly creates an identification problem. So we propose a different way to identify how significant these cross-impact coefficients are and what are the main drivers of execution costs. So what we do is a PCA on the correlation matrices of returns and OFI. We propose a factor model for the order flow imbalance, and we use this first principal component of OFI to then test what is the remaining significance of any cross-impact coefficient. If you can move to the next slide, please. So this table shows the PCA of returns and order flow imbalance. Again, 1 minute. It shows the eigenvalue of the first 3 eigenvalues, just for simplicity, the variance explained by each eigenvalue, and the cumulative variance of the eigenvalues. So for the returns, we can see that the first eigenvalue is 21, which explains 32% of the variation of returns, of 1 minute returns. The second, this is actually a bit larger than previous studies. So there was one of the major studies in the Q's PCA for returns and OFI was by Hasbrook and Sepp in 2001. And they found a first principal component explaining about 20%, 21% in returns. The second principal component is much, much smaller and explains 2.5% approximately. And the third component is just over 2%. So the 3 first principal component roughly explain 37% of the variation in returns. If we move to the order flow imbalance, then the first principal component is a bit smaller, is 19%, but it's so it explains 29%, which is actually quite similar to returns, a bit lower, but on the same ballpark, let's say. The second principal component is just under 2%, and the third is, again, 1.8%. So the total, the 3 principal components of OFI explain a bit less than for returns, but we are on the same scale. So we suggest using a 1-factor model for order flow imbalance, where the order flow is regressed against the first principal component of OFI, and basically the eta, which is the residual of this regression, we interpret this as the idiosyncratic component of order flow, which is what was on the top of, if you remember, the causal diagram. So in order to disentangle basically the contribution of the idiosyncratic contribution of a stock's own order flow from the common component due to cross-trading, we use this approach where we take out the first principal component and we interpret the eta, the residual from this regression, as the idiosyncratic order flow due only to action in that stock. If you can move to the next slide, please. So this shows actually the correlation matrices of returns and OFI, and the first principal components. So the first principal component are normally related to the overall market movement. So in this, so these two matrices show, so on top is the correlation matrix of returns, and on the bottom is the correlation matrix of order flow imbalances. So the RQQQ is the returns standardized of QQQ, which is an ETF that tracks the NASDAQ 100. So it should be the one that is closer to what we use in our data set. Our SPY is the returns on the SPY index, which tracks the S&P 500. And F1R is the principal component of return, the factor 1 of returns. And similarly for OFI, we have the order flow imbalance of the ETF QQQ, of the ETF SPY. And we wanted to see how closely related the first principal components are to the overall market movements. So as you can see from the figures in blue, from the numbers in blue, then the first principal component of returns has a correlation of 91% with the overall return on the ETF that tracks the NASDAQ 100, which is incredibly high. And it's a bit lower for the SPYs, 88%. If we move to the correlation metrics on the bottom, then, so we can see that the first principal component of OFI has a correlation of 82% with the order flow imbalance on the ETF QQQ, which tracks, the NASDAQ 100. So we can see that the first principal components of both the returns and the OFI are really closely related to the overall market movements. And moreover, if you move to the next slide, the two first principal components are actually very closely related to each other. So overall movements in the returns, the first principal component of returns is on the y-axis, and the first principal component of order flow imbalances is on the x-axis. They have a correlation of 87%. We checked also second component is still quite high, 56%, but we focus on the first one. So we can clearly see how the returns and OFI are driven by common components due to commonality in trading in this example. If you can move to the next slide. So this kind of justifies approach, which is once again a two-step approach where we want to kind of take out whatever is due to commonality in order flow and hence in returns. So in the first step, what we do is we regress a stock order flow imbalance, as I explained before, on the first principal component of OFI. And the residuals, which are eta here, just explain the idiosyncratic parts of the order flow imbalance of stock I, which is not due to any other thing. So it's not due to the common movement, common market movement. In the second step, what we do is we regress each stock's return on the first principal component of OFI to account for the commonality, and all the idiosyncratic stocks order flow imbalances. So just to be clear, we do regression number 10 for each stock I. We have 67. So we have 67 etas, which are basically the contribution of each stock's order flow imbalance without considering the commonality that exists between them. So in this way, we believe that the matrix phi in equation 11 should better capture whatever is defined as cross impact compared to the matrix beta that we had before because the beta that we had before didn't have the common factor of order flow imbalance taken out. So we could not distinguish between correlation in order flow, as Rama explained, and cross impact. So if you move to the next slide. So this is actually looks very, very similar to the one that we've had before, but just because when it's 0, it's 0. So it once again shows that in this case, this is phi instead of beta. It once again shows that the diagonal elements of impact are much, much larger than the off-diagonal elements. And if you can move to the next slide, then this one shows once again, so on the top we have the self-impact coefficients, which are in blue. So these are the phi II, and the cross-impact coefficients and the phi ij. And then we have the PC1, which are on the bottom in green, which are the gamma. So this is quite similar to what we had before. So it shows, the one on the top, it shows that the self-impact coefficient, so a stock's own order flow imbalance is a major determinant of a stock's return. But it also shows that the green in the graph on the bottom, histogram on the bottom, shows that equally important is the commonality in order flow among stocks. And once you take this into account, these two are of the same order of magnitude. And you can see that the red, which is the cross impact, is actually almost is very, very tiny. And I'm not sure you can see from this, but actually once you take the PC1 into account, almost all of these cross impact coefficient change sign. So most of them become negative. Which poses another question, which is, I mean, first of all, are these cross-impact coefficient, even if they are identifiable? Let's say that, you know, once you remove the PC1, what's left is cross-impact. Okay, so this is the red one. Even if you can estimate them, are they, first of all, significantly, both statistically and economically in terms of magnitude? And the other question is, are they stable over time? I mean, as Rama explained, there's been a lot of paper and in building model of optimal execution where they assume cross-impact, huge models with a lot of cross-impact coefficients, but they rely on these coefficients being stable over time. And if they're not, then the interpretation is quite difficult, and as well as the use. If you can move to the next slide, please. So in order to assess whether these components are, again, statistically significant and economically significant, I mean, we've already seen that they're very, very small. So it could be ended there. But anyway, we more formally test how much do cross-impact terms contribute to explain the execution cost of returns in this case, once you take a stock's own order flow already into account and the principal component into account. So in regression, so these are two nested models. Equation 12 is basically what we are saying is, well, the return, no, Rama. Yeah. So, so in equation 12, what we are saying is that a stock's return, as the original, you know, the first equation that Rama showed you, is determined primarily by a stock's idiosyncratic order flow and the principal component of commonality in order flow across stocks. In equation 13 is what I showed you before with the heat map and with the other histogram. it says that you not only need a stocks on order flow, but also the remaining 66 order flow imbalances. So these are nested models. If you go to the next slide, please. So statistically we test, and with an F test, actually we cannot reject that they are zero. So statistically they are significant, all these cross impact terms. Economically, in terms of magnitude, you can see on the top the R square, the adjusted R square from the first regression, where we just use a stocks order flow imbalance and the PC1 on the order flow imbalance. And in the bottom, there's the adjusted R square, where we use all the other order flow imbalances as well. This is, as you can see, it's hardly distinguishable, and the small graph in the bottom shows the difference in R square between the two. And on average, by adding all these regression, all these other order flow imbalances to the regression, just increases your R square by 0.005 percent on average. So the conclusion, I guess, is even though they're statistically significant, by creating these huge models of, and including blowing up your matrix of impact coefficient to an n by n matrix, you almost don't gain anything in terms of explanatory power. So we are in favor of more parsimonious way of modeling impact, where if you go back to the slide before that we had before, please. So where we basically use regression 12, where you only need a stocks own order flow imbalance, and what you need to model is the correlation of order flow imbalances. That's all you need, and you don't need all these other cross impact coefficients. If you can move to the one after this one. Yeah. So as I mentioned before, there was another final element, which is, I believe, very important. And it is not only the economic significance of this cross impact term, which we just saw, it's, I mean, it's very small. They don't contribute almost anything to explanatory power, but also their stability over time. So as I said, so this multivariate impact model rely on the calibration of this matrix of cross impact coefficient and their stability over time. And so this is very important. And so if this sign change sign, so if this, if this cross impact terms change sign over time, this can be very, very problematic. And as we saw from the regression, we saw that once we took the order flow, the PC1 of the order flow imbalances into account, 80% of cross impact terms became negative. So this suggests that they might be unstable. So this kind of triggered us to look at the change over time. So what we did is an analysis of subsample. So we divided our 2.5 years of data into 30 monthly subsamples. And for each of these subsamples, we ran the same two-step procedure that we did before. So the PCA analysis that we did before, where we regressed the OFI on the principal component, and then we regressed it against the PC1 and all the other order flow imbalances. So if you go to the next slide. So this is an example of what you get for most stocks, looks very similar. So this is Apple on the top, and on the bottom is Costco. On On the top, you have the self-impact coefficient. So that's the coefficient of one stock order flow imbalance on its own return. And you can see it's positive and you know, quite large in magnitude, as we already seen. And it doesn't, I mean, it fluctuates over time, but not that much. So the shaded region are 99% confidence intervals. On the bottom, you see the cross-impact coefficient, which is the phi ij. And you can see, I mean, we've already seen that they are very small, but what you could see from this analysis is that they fluctuates. The one on the bottom, Rama, it's if they fluctuate over time, and they become positive and then negative and then positive. So you can see the confidence interval are all over. So the sign could be anything. And that's really something you don't want when you want to, you know, calibrate an n by n matrix, and, you know, you calibrate it on coefficients that are changed continuously over time. So if you go to the next slide, please. So unless you want to do you want to do a conclusion, Rama? Or?
Yeah, I mean, we have, yeah, our time is up, so we have to conclude.
Okay. Okay.
I guess, so what we tried to show you is that, you know, the phenomena which people refer to when they, to justify these cross-impact models with an impact matrix having off-diagonal elements, is that there's positive covariation between the returns and the order flow imbalance of different stocks. But this phenomena can be explained without actually introducing such high-dimensional models with many coefficients, and without even using the concept of cross-impact, simply by noting that order flow imbalances across stocks are correlated. And in fact, what we showed through the analysis of this NASDAQ order book data is that a fairly simple model, one-factor model for order flow imbalance, where the order flow imbalance of each stock has one common factor plus an idiosyncratic factor, that goes already a long way in explaining the patterns that we observe in the cross correlations of returns and OFI across stocks. As we showed, you know, you can go further. You have a principal component analysis. It's fairly easy to extend this to multiple factors, but with a single factor, we see that it's enough to explain the magnitudes of these so-called cross-impact terms without introducing more parameters into the model. And then another important thing that was shown in Francesco's slides is that if you do insist on introducing these cross-impact parameters, well, then you really need to check that they're stable and the interpretation is meaningful. And when you try to check the stability, you see that they're unstable over time. And in particular, the sign will fluctuate in a seemingly random manner from one month to the next. So this may make them very difficult to really use in a practical setting. So what we think is that it's more important to, if you want to build a multi-asset impact model, which you probably all do because you trade portfolios, what you need to focus on is building a model of common factors in order flow. And this can be done in many ways. A linear factor model, as we showed already, goes a long way. You can do it with principal component analysis of order flow. And once you have a good model for the correlations across order flow across your assets, then you can just deploy your single asset impact model, which relates order flow in each asset to its own return. And that's perfectly sufficient for explaining the amplitude of execution cost in portfolio execution. You don't need any other ingredient. That's what we wanted to show. Thank you.
All right, thank you very much, Rama. We have a very complicated question by Arseny, which I'm not sure if you guys.
Yeah, I can see it. Shall I read it?
Yeah, go ahead.
Yeah. So Arseny is asking to explain how you'll decide to limit your OFI decomposition to just one factor per idiosyncratic component, because on the slide where we have the principal component analysis, you see a fair amount of variance in the second and third factor. That's true. So it's not really concentrated in one factor. Yeah, so you're perfectly right. If I were an execution quant and my job were to do this, like you, I would do this. I would do a multi-factor model. And conceptually, it's not more complicated than what we did. You can you can use 3 factors. And as you can see, with 3 factors, you explain 90% of variance, and then you're fine. So here we saw that with one common factor, we explain a lot of the, we can explain the magnitude of the correlations between the returns and order flows, but their finer effects, for example, if we look at portfolios with long or short, then you can explain those finer effects with the higher factors. You're perfectly right.
But if I may, Rama, actually adding the second and third factor actually didn't change to answer any question.
For what we want to do here, but because we only look at long positions.
Okay.
Yeah.
So I wonder, I have a question a bit about the applications of, you know, these links between OFI and returns. And you talked about an optimal execution problem with multiple assets. So when you're thinking about what kind of applications we could use your results to build upon it, would you think that, are we talking about optimal execution of portfolios, or about, is it related to stat arb or co-integration, or why should one really go through the trouble of computing the order flow imbalance?
Well, I think one thing you want to do is you want to analyze your execution cost ex post even. So I'm not even talking about optimal execution. So you do portfolio execution, and then ex post you want to quantify your execution cost. So every fund has some transaction cost analysis model in-house, which they use to decompose basically the return into the gross return and the execution cost. So this execution cost is not directly observable. You need to have a model to access that. So this kind of model enables you to do that at portfolio level. What it tells you is that because of the commonality in order flow, the execution cost of a portfolio is not equal to the sum of execution costs of each component looked at in isolation with a one single asset TCA model. Right? You need to look at the portfolio. So that's what it says. And the difference between these two is linked to the commonality here.
Mm-hmm. So if we're executing a buy order of every asset in the SPY simultaneously, we should expect to have an impact on the OFI of SPY.
Yeah, I mean, think of a simple problem. Don't even think about a TCA. The bid ask on a portfolio is not the sum of the bid asks on the components. It's smaller because there's a portfolio effect, and you know this model just quantifies that in a more general setting. Instead of the bid ask, it gives you an estimate of execution cost, and obviously the common component plays a role in this.
Mm-hmm. Oh, we've got another question from Swagato Acharji. Would you have any thoughts on how cross impact can be incorporated into more prevalent square root or power law impact models to understand impact of trading portfolios?
Well, you know, what we're saying basically here is that you don't need the concept of cross impact. what you need is a good model for impact for a single asset, plus a good model for the common factors in order flow across assets. So you pick your favorite single asset impact model, and then you model the common factors in order flow, and then you have your multi-asset impact model. That's what we're saying.
And I guess finally, we're going to end after this. We have a question from Jinping Shi, who says, have you tried, so we're looking at equation 12. And he says, have you tried to use the first principal component from return in 12? In other words, yeah, so I guess here you're using the principal component of OFI. You know, what's the difference if we use returns here?
Well, I mean, first of all, I mean, we showed that there are almost like a 90% correlation. So, and I mean, we just actually wanted to follow our causal analysis to show that you actually need to model the commonality in order flow imbalances to explain the returns. So it's a different question. It's a different approach, I think.
Yeah, but it's shown here. It's shown here. The two are very correlated, yeah, and the correlation is 87%. So, but if you put the return factor here, then it's you know, I mean, you can correlate anything with anything, but as Francesco says, we want to have a causal model where you have an interpretation for this equation in terms of A causes B. So here, what we say is that the order flow, the common factor in order flow, influences the order flow of stock I, which then drives the price of stock I. That you can give it as a causal explanation. If I tell you the return of stock J influences the return of stock I, well, yeah, maybe in a regression they do have a correlation, but is that a causal model? We think that there's no causal model there, it's just correlation.
Okay, Rama and Francesco, thank you very much for this very inspiring talk. So I hope you have a great night. I know it's a little bit late in Europe, so we give you the best the best wishes, and we'll follow up on things like sharing slides, you know, sharing videos, and we'll keep you posted on our email letter.
Yeah, thank you, and thank you very much for everybody's